Adjunct Professor Moran, Macroeconomics 111. In this session, we're going to discuss a document called the Balance of Payments. And this is a record the government keeps in order to track how much we're importing, how much we're exporting, and what this money is being used for. This is important because when international trade happens, the currency that has to be used is the currency of the seller, whether it's a good or service or a capital good. If a foreign tourist comes to a hot dog stand in Times Square, the hot dog seller in Times Square will want to be paid in dollars. So if someone comes from Europe, for example, the hot dog seller will not want euros. And if you travel overseas to Mexico, well, not overseas, if you travel south of the border to Mexico, for example, the people there will want to be paid in pesos, their currency, not dollars. Although the dollar to some extent is an exception because it's valuable and usually they'll take it, but you will not get a good exchange rate on it. So you want to actually go ahead when you travel overseas and exchange your money for their local currency, and we'll talk about exchange rates in a later video. So what we want to measure here is we're going to try to measure something called a current account, a capital good, and a capital account. Current accounts include what people traditionally call the trade deficit, the difference between exports and imports of goods and services. Also in this current account is income earned when Americans invest overseas minus income foreigners earn in the United States. And also something called net transfers, which is money that foreign aid that we send overseas, for example, the United States overseas, or pensions earned in the United States but paid to citizens who now live overseas, or money sent by immigrants to their families back home. This would be in net transfers. The capital account is money sent overseas when Americans invest in an investment overseas, or money received by the United States when foreign investors buy investments within the United States. Once we measure this all up, we'll either have a surplus of foreign currency or a shortage of foreign currency. So if we export more than we import, we'll have enough foreign currency to buy the imports we want. But if we import more than we export, then we will run out of foreign currency. And it will be the government's responsibility, monetary authorities in the United States will go into the international market and get that currency in order to facilitate trade. Because if we run out of foreign currency, no further trade can happen. Or instead of getting it in the market, the federal authorities could have it from prior surpluses that were run when we had a trade surplus. So let's take some examples and calculate a balance of payments sheet. So here we need to make two decisions for each transaction. Are we gaining or losing currency? And is it going to go into the current account or the capital account? Current account, again, purchase of goods and services, or earning or spending income domestically compared to overseas. A credit is when you gain currency. A debit is when you lose currency. So a credit is when you earn currency, you gain it. You lose currency when you use the currency to buy something overseas. Harley Davidson purchases $25 million in production machinery from the Japanese economy. So we lose currency, but we have investment. We have capital equipment that we've gained. Entrepreneur, the U.S. entrepreneur invests $50 million to develop a theme park in Malaysia. We've given Malaysia currency, so that's a debit, but we gain an investment, a capital account. A Chinese company sells $1 million worth of berets. So we lose currency, but we gain a good. BMW pays $1 million to a U.S. shipper for transporting cars from Germany to the United States. So we gain the currency and provide a service. Each month, Emma Grant, who recently arrived in the United States, sends half of her paycheck to her sister in Poland. So we're losing currency, and that goes in the current account, net transfers. The Bank of America pays $5 million in interest to French depositors. We're losing currency, and that goes into the net investment income. Again, sometimes we'll buy investments overseas, that goes into the capital account, but when it pays income, it goes into the net investment account. So that is the flow of income. That is a current account. Senor Ramos from Spain buys a shopping center in Florida. So we're going to gain the currency, and that is a capital account. When that shopping center, when they pay rent, that will be income earned, Senor Ramos, and that will be counted in the net investment account. The purchase of the shopping center goes into the capital account. The flow of income resulting from that investment goes into the net investment account. A Brazilian investor buys 5 10,000 U.S. Treasury bonds. So we're gaining currency, and that is a capital account. When that capital account pays interest, it will go into the current account, net investment income. German tourists spend $3 million in the United States. American tourists spend $5 million in Germany. So we are losing currency overall, and that is goods and services in the current account. British, London, based in Britain, British company, record store, spends $10,000 on CDs made by the Generic Goyles from Brooklyn, a kiddie pop group. So we are gaining currency, that's a credit, and it's goods and services. Finally, Zamboni, a U.S. ice rink magnate, which has to use a Zamboni machine to clean the ice, buys stock in a Chilean, where it will be Chile, ice rink. It's a Chilean company, so we are using currency, and we are buying an investment. That's a capital account. Now we can drop these, we can do an example of a capital account and see if the country is running gaining currency or losing currency. So here we want to net out our transactions. So we've gained currency by exporting goods and lost currency by importing them. Credit, debit. We also can export and import services. 150 of export services, 120 of import services. That doesn't look right. So we have a 70 debit on goods and services. We've imported 70 more than we've exported. This is what people generally mean when they say a trade deficit. We're importing more goods and services than we're exporting. But we've earned 10 more on investments from overseas than we've paid out to foreigners in other countries of 10. But we've lost transfers of 14. Either because of pensions being paid to Americans overseas, or immigrants sending money home, or foreign aid being paid from the United States to other countries. So we're going to take that negative 70, add 10 in, and subtract 14, and we have a balance on the current account of negative 74. Now we can look at the capital account. The purchase of investments overseas, the capital account, as opposed to the earning of income, which is net investment income, on the current account. Here we've lost currency by buying assets overseas, but gained currency because foreigners are buying investments inside this country. And as a result, since foreigners own more capital investments in this country, they've invested in more inside this country than this country's have bought overseas. They've gained 50 of currency. Now we can see overall whether this country has gained or lost currency through international trade. And they've lost 24. That means the government will have to go out and get that 24, or this amount of trade will not happen because this country won't have the currency to buy things from overseas. So the official reserve account will be the opposite of this number, and trade balances, the balance of payment sheets, measuring the value of foreign imports and exports, gains and losses from trade, and their uses, current or capital account.